Hey everybody, it's Roger King. Welcome to the Real Estate Investing Evolution. Today is July 11th, 2023. And the topic I'm going to describe is something that I've been looking at over the last probably 6 months or so. It's brought a lot of concern to me, and this is what I like to think of as a limited partner catastrophe. So, as we are about to jump in here, please hit subscribe below. And if you have any questions or comments, feel free to post them below, and I will jump in and answer anything I can right away as soon as I hear about it. And I appreciate the support. So, let's jump in. I find it really fascinating that over the last probably 6 or 8, maybe 9, 10 months, I keep hearing about multifamily investors that have been really concerned with what's going on in the lending world. I'm hearing it from both the general partner as well as the limited partner, but also the lending institutions and a whole host of various investors and authors and commentators. And I've been speaking with some friends that are pretty involved in these types of investments, multifamily. Some people, most people that I've been in contact with are limited partners, and they've got a growing concern that their general partners aren't able to do what they had promised 2 or 3 years ago when they invested their $50 or $100 or maybe even $200,000 into a specific multifamily syndication. And a lot of that revolves around the recurring debt. And I'm finding out, almost daily, the various institutions and the various companies that are in a really difficult position because of these changing interest rates. And they got into interesting loans that have been starting to change the way their interest rates are calculated. And this is really, truly a growing concern. And I came across an article, somebody sent me an article somewhere, I can't even remember, maybe it's in a WhatsApp group. And I find it very interesting. And what I want to say before I jump into any of those details, and I'm going to share this article with everybody, I don't believe that people are inherently bad. I think that people are inherently good. I think that most people want to do the right thing, that most people are striving for legitimate success, that most, if not, and I would say 90 to 95% of the multifamily syndicators out there truly do wish for success for not only themselves, of course, but for their investors. So I don't think that this is a situation where the industry is turned upside down because of greed, ineptitude. But I think that there is a situation here where inexperience is ruling the world, if you will. And so let me go ahead and just remind people that even the smartest investors lose money. And as much as they don't want to lose money, as much as they love Warren Buffett's major set of rules, rule number one is don't lose money. And rule number two is look at rule number one. I don't believe that every investor is completely successful across the board, and that even the smart investors lose. And it's just because of unforeseen circumstances. I've got a good friend who invested in a bunch of multifamily in Houston, Texas a few years ago. And there were hurricanes, a couple rapid hurricanes, and the property could never really recover due to a bunch of infrastructure, flooding damage, and the properties they lost money. And I know he contributed to make his investors as whole as possible. They still lost money. And those are acts of God that you can't necessarily account for. When you look for a flood zone that is a 500-year flood zone, and two hurricanes hit within, I think it was 3 months of each other, maybe less. I'm not specific on the particulars, but there were not any ways to necessarily see those things or to plan for two major flooding events. So I think that even the smartest people get caught sometimes. So anyway, let's jump into this article that I just found. And as we can see here, the title of this is Tides Equities Flew Too Close to the Sun and It Wasn't Alone. And what this article really shows is that multifamily syndicators, GVA, Rise 48, ZMR, and Natia face a reckoning. And this is pictures of some of the leaders of those organizations. And it showed that this particular Tides Equity is needing to do a capital call to salvage properties with negative cash flow and declining occupancy. Now, the declining occupancy is a really interesting thing. And I find that, even though we're in a housing shortage across the United States, that multifamily properties in specific areas are still not doing well. And why is that? I have a hypothesis. And part of that leads to that people don't want to live below their means, I think is one portion of it. So when people, like many of these syndicators, buy these garden-style apartments that are 40 years or 50 years old, and they renovate them, they do a value add, as they call it. They're looking to reposition the properties, that even with that, new countertops and new appliances and new bathrooms and new carpet or floor, doing the pool and adding these amenities, because of the design, people still don't want to live there. And they'd rather spend $2,300 a month on a two-bedroom apartment than $1,700 a month on a three-bedroom apartment that's 40 or 50 years old, even if it's brand new inside. There's just this panache, if you will, of wanting to live an affluent lifestyle. The idea that spending that $500 extra is worth the time and the cost, let's say. So I don't necessarily think that there's a bad problem with that, but I do think that there are problems inherent with the misconception from general partners that just because it's redone means that it's automatically going to increase in value. Anyway, let's keep going through this article here. This is again in The Real Deal. This company, Tides, acquired $7 billion in multifamily and taking out what I think are some risky loans. They're called floating rate loans with these 2 and 3% interest rates. But again, that's 2 or 3, 4 years ago. And then when the Fed had started to raise the rates to offset their idea, this perception of inflation, and obviously, yes, there's inflation, but the reasons for inflation, we will eschew the political drama around that whole concept. But because the Fed started to do this, we realized that the interest rates for people just like this are going to fall into some really difficult times. And with, I don't know how much, if they're 60%, so what's that, $4.6 billion or $4.8 billion, I don't know, of loans, of debt with banks and whatnot, they're coming due. And so it says at least $1.5 billion of the firm's floating rate loans mature in the next 2.5 years. So how does somebody get into this, reposition it, which means doing all the renovations so that more people will want to live here, and then creating a higher NOI, which means the value is higher, refinance it in this 2.5 years, and then get a lower interest rate? It's not going to happen. So they're going to have to figure out some sort of a workaround. But it's not the only company. A number of small-time investors have been, we're faced with some challenges here. A number of small-time investors lured by the cheap money of yesteryear employed the same value-add strategy. Syndicators pooled money from well-heated yet largely unsophisticated investors, promising outsized returns on multifamily deals. And I think that this really gets to the crux of what we're talking about here. And that is that a lot of investors that had $200,000 or $500,000 saved said, hey, I'm going to play in this world as well, and found out these syndicators who had 5 or 10 years experience buying these portfolios and adding to their portfolios with really cheap money, thought that this gravy train would last without understanding that the floating rate mortgage is going to go away, without realizing that the occupancy is going to maybe increase even with the value add process, the renovations and the added amenities, and that there's going to be this drive for these types of investments, but it's going to not pan out. People were not aware of this. And so now we've got all of these investors who are truly challenged with the idea that they're not going to make any money. And they're starting to get scared. And this is why I call this the limited partner catastrophe. It's because those folks that put in, even the guys that put in $10,000 into, some sort of a crowdfunding site, are finding themselves asking themselves, why did I do this? What's my exit? How can I get my money back? Not just make 15 to 18% annualized return, but how do I even get my money back? It's a problem across the board. And this is part of the real estate market cycles that people don't really pay attention to. So I think that, to sort of recap everything, I don't believe that everybody's guilty of trying to scam everybody. I think that there's some inexperience with this idea that floating interest rates are going to be fine, because I guess philosophy a few years ago was, well, if it's 2.5 now and it goes up to 3.5 or maybe 4, we're still going to be okay. But they never calculated that it would go to 7 or 7.5. I don't know that the interest rates rising is going to stop anytime soon. I think that there's still a lag time that we're dealing with. Again, today's July 11th, and I think that there's some market lag on these interest rates. I think that also people are learning that experience truly matters in the multifamily sector. But even with that experience, you just can't plan for some things. Again, too many people, too many really super smart people have been in this business for 20, 30 years, have bought millions, if not billions of dollars in assets, repositioned them, turned them around, and got in, got out. Everybody made money. But because of this part of the market cycle, when the lenders want to recoup their money first, and they're entitled to recoup their money first, they're raising the rates. And if they have to take these properties back, they'll do it. So I want everybody to understand that even though it may seem like bad faith in many instances, we really need to ask, is it truly bad faith? I don't necessarily think so. I think it's a market condition. But I do believe that inexperience rules the day right now. And that inexperience is going to provide some heartache for a lot of people over the course of the next 2 years. Conversely, it's also going to provide a ton of opportunities for those people that have already been in this business for 20 and 30 years, that have liquidity set aside for these sales and these liquidation events with the banks. The bank pulls back a property, it's going to want to sell it, get it off its book right away. So there's a downside, and then there's always an upside in this market cycle. I feel like people are learning dumb mistakes the hard way, but that's the way this is. Real estate investing is not an easy path to riches. It shouldn't be. It's not. It can be, but you got to be prepared. You have to think, what's the worst that can happen? And the follow-up question is, can I survive that? Can my portfolio deal with that? So if somebody's investing in a particular company and they've got 5 properties in Houston, Texas, or in what's another great area that's not a great area, but an area that's starting to struggle, call it, I don't know, somewhere in Georgia maybe. People bought a bunch of property in Atlanta and they've decided that let's go all in Memphis, another city I heard about years ago. And so I know friends that bought into a bunch of property in Memphis. And there's not enough geographical diversity. And I know that some of those people just bought single family homes, but I also know that they were also focused on that city, which is okay. We've got some concentration, but we've also got enough properties around the country that can help some of that geographical diversity really expand and protect some of our downside in other areas. And I would urge you to, when you're looking as a limited partner, you're looking to invest some capital, because we're always trying to find good investments. Sometimes it's smarter to sit on the sidelines with cash. I think that's true. And that's up to you and maybe your advisor. But if you're looking, you want to find out, where is the company's complete portfolio? Is it strictly in 1 or 2 cities, or is it really geographically diverse, so that if this city and that city are problematic and those cities' population growth starts to stall, or there's new legislation that is not helpful to repositioning, you have other cities that they're invested in as well? Or are you working with somebody who's only been in this business for 3 or 5 years and they've only got 3 or 4 properties? You need to pay attention to what are the geographical diversification risks, or better said, maybe the geographical concentration risks. What are the opportunities that are outside of those particular areas that they're looking at or maybe not looking at, and who is looking in some of those areas? Every day I get a new article that shows these are the top hot cities right now. You may want to explore people that are investing in those cities, or what are the top secondary cities, or what are the top tertiary cities. And we can go through some of those here in some of the next episodes. But I think it's important to really pay attention so that we're not in a limited partner catastrophe. Doing your due diligence on the general partners and their histories and their experience. Do they have more than 5 years or 10 years or 15 years or 20 years? How do you find that? You've got to ask those questions. So if you're just kind of tuning in now, really here to help people understand what are some of the questions we can ask moving forward. So how many years have you been in business? If you want to refine that question, you could even say, how many decades have you been in business? How many cities are you invested in? How many metropolitan areas, or MSAs, metropolitan statistic areas? How many of those are primary, secondary, tertiary? There's a whole host of ways you can really go about finding out where they are geographically diversified, how their portfolio is allocated, what kind of properties. Are they all C level properties trying to make it into B or B plus? Or are they trying to do E to A, which is difficult? Are they in A areas and they've got a C apartment? I would just really explore what their strategies are so that you don't do too many of the same types of investments. I think that this is a really interesting time. Keep paying attention to all of these different bits of information. Help yourself form opinions on what's most important to you, and you're going to get through this. Keep some money in cash, and we'll go from there. So if you guys like what I'm talking about, what I'm saying here, please hit the subscribe button. I'm growing this platform as much as I can. I'm still a very active investor, and I hope to answer any of your questions As soon as you guys write them, feel free to put them below, and we will continue this discussion next time. And I'll put a link to this article in the comments below. Okay. Hey, everybody, have a great day, and we will chat very soon.